Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content out on the internet. The best place to get access to that is to follow me on Twitter, which is at Focused Compound. If you're interested in learning about our managed money services, reach out to me at andrew@focuscompound.com or go to Focus Compounding, our website, and click that Invest With Us tab to get access to everything that we are doing on the money management side of things. We have a blog going all the way back to 2005 on our homepage, www.focuscompound.com, that you can get for free. All of the information is down below in the description. So, Geoff, how was your long weekend? How was Memorial Day?
Good.
Did you spend some time, grill some burgers, grill some hot dogs, eat some watermelon, spend some time outside?
I spent some time outside, yeah.
You got a good tan going. It's good. Could tell you're outside. Yeah. It's good. Glad to hear it. Do you, long weekends, do you just like look forward to them? Just time just to hang out? Markets are closed, get some good reading in?
It doesn't make any difference to me. I don't actually keep to not working on weekends and working during the week. The market being open or not doesn't matter that much to me. You do the transactions, so we don't really change that much what we're buying or selling. So when in the middle of buying something, then it goes on for weeks, and I don't really do anything except see how much we've bought or something.
Is there any difference between your Saturday and Sunday from Monday through Friday? Yeah.
No.
That's good. I mean, you talk about creating a life for yourself or having a job or a career where it's more of a lifestyle, right? I mean, you're doing something that you would be doing if you weren't getting paid for it. Glad to hear it. I think a lot of people listening are probably in the same boat. Anyway, so before we jump into our topic for the day, we can go over to the PowerPoint, talk a little bit about where we are in the world and in the market. S&P 500 is up about 9% on the year. Today is May 31st, 2023. 10-year yield is at 3.66%. Crude oil, $68, and natural gas, $2.33. And I wanted to bring this up. We've talked about FANG in the past and how the vast majority of the market movements are correlated or make up of, those stocks. Well, the 1 trillion market capitalization club is the new, group. So what's the acronym for that? What are people going to come up with? I'm not exactly sure. But it's made up of Apple, Microsoft, Alphabet, Amazon, and Nvidia. And just 5 stocks account for 96% of the S&P 500's gains this year. So does that remind you much of like the Nifty 50 era? Does that remind you of, anything? I mean, it's kind of crazy how just much the market's gains, the S&P 500, right? So subtract 5 stocks and, the rest of them aren't driving the market's returns year to date. Is that kind of crazy to you that, the vast majority of the market movements are made up of these 5 securities?
It happens at the end of bull markets a lot. It happened at the end part of the .com. It kept getting narrower and narrower. So people that were in more speculative or whatever tech stuff, smaller things, lost a lot of money in that or sold that or moved on to other things, and then they all focus in on the same stuff. It's a pretty common feature. We've talked a little bit about it, how like you can have bubbles in multiple things. Like there's a bubble in something and then it somehow moves on to something else. So you'll have SPACs or whatever, but then there'll be something else that people can find with that, and then something else. It tends to be a particular period of time has a lot of that, not just whether it's just stocks of a certain kind or something like that. It also could be speculation and lots of other things. You have Nvidia there, and that's probably the biggest in terms of year to date. I don't know. It probably went from probably close to $400 million market cap. I'd probably guess around 400 million to a trillion.
400 billion.
400 billion to a trillion, yeah. And so, which is remarkable. And what's remarkable about that too is in terms of what it was earning in the past. We talked about Paramount, right? Which is, I think, enterprise value is 30 billion or something. They used to earn about the same amount. These two companies, actually, in many ways, they're about the same size and stuff as of a few years ago. And you have a stock that obviously is incredibly highly valued because of this scarcity idea of like people want to get in on a theme, and there's not enough publicly traded stocks to participate in that. So this is like about AI in people's minds and stuff. The stock, to give an idea of how overvalued this is, I would estimate it has to go up 10 to 15% a year, the business value, for like 15 years or something, for you to get to a level that would be in line with like what other stocks would do, So this thing has to outgrow other stocks by 10 to 15% a year, just to, if it can do that, probably 15% a year for 15 years or something. If it could do that while you hold it, you might not lose more money in this than you would in other stocks. Like it has to, that's how much it has to get to just to be even with other stocks, right? It's already baked in that it's going to outperform other stocks as a business by something like 15% a year in terms of growth and stuff, which would be remarkable if it did that. On the other hand, the business isn't very big, right? So it's $1 trillion market cap, but it's actually not a big business. And so, like if you look at like revenue and gross profit, the things that would matter, it's not a big part of the economy or something. So it could grow pretty fast, it could be impressive that way. But yeah, it reminds me a lot of Cisco, which got to a valuation like this. Yeah.
37 times revenue. It's crazy. I mean, so is that the new movement? It's going to be like the AI bubble, but it's crazy because, I mean, like these other companies are still in that basket. I mean, at what point are you like, maybe we're not in a bubble? I mean, rates have gone from zero to what they are today, and these stocks just haven't even skipped a beat. I mean, do you ever think about that? It's like, well, maybe I need to respect price action in that regard. Microsoft, Apple, Alphabet, those companies do generate a ton of cash. Nvidia, though, you're right. I mean, this isn't a big business and it's trading at $1 trillion market cap. And then there's Amazon, which, as we've talked about a lot on this podcast. And last week we spoke about how you don't believe the returns going forward are going to be as good as they've been in the past. I mean, there's just no way they could be because they're just outlaying so much capital. I don't know. It's almost like, oh yeah, we're in a bubble. But a couple of years ago we could say, oh yeah, we're in a bubble too. 3 or 4 or 5 years ago, we could say, oh, we were in a bubble too. And a lot of these companies were in this basket. I think of, I don't want to call some fund managers' names out, but, there were a lot of prominent hedge funds that were short these baskets. I mean, I remember even back in like 2012, 2013, and I think Apple was in there, Alphabet was in there, Amazon was in there, and it's just continued to go up. It seems, it's just shorting's been it's been a loser's trade in this market really since 2008.
Yeah. It depends on how you define success, right? If you will have been better to have not been in the market than to have been in the market, right? At the point that you decide, oh, it's too expensive, it's a bubble. And you can say, okay, I should get out, I should short, or I should do whatever. And then there's another point where you say I should get back in, and it's lower than what you said I should get out, or lower, adjusting for the fact that you can hold cash and stuff. Then probably that's a good decision, And so you won't be able to say that this is a top in something, but the other thing is the overall market hasn't done that well. If you think about it, if you got out a while ago and were holding cash, or went into other things, You could have done pretty well. I mean, certainly if you like, although shorting may not have done that well, certain long short things definitely have done well recently. I mean, since COVID, probably things like, I mean, if you take the extreme things that are, we're not going to name fund manager names, but the extreme ones that are long certain things only, fintech, technology things, money losing things, stuff like that, and compare it to like David Einhorn or something. Einhorn's
Okay, that's who I was thinking when I said the bubble basket.
No,
That's what I was thinking
he's done better than that.
Yeah.
Kind of thing. Now, if you compare an index or what you could do in certain other things versus what some of these people are doing, I mean, the issue with something like Nvidia, would I short Nvidia if I was investing my own money or something? I don't know that you need to, right? Like, why do it? But yeah, it's very difficult for it not to lose money for people. And it's sad because it's a huge amount of money too. Like Nvidia is going to be like, a fund that brings in a lot of money and brings in a lot of people who never made money on Nvidia. And now they're going to lose a lot of money on Nvidia. But that's the same issue when we talk about Tesla or any of those things. There's some people who are early to it and make a lot of money, but then most people get in later at a crazy price. And that's what we're talking about here. So we'll see what happens with it, but there's just statistical problems with it, right? So it's 4% of GDP right now. So that's a bit of a problem. It's a little bit more than 4% of GDP. That's a bit of an issue because when you start thinking about, okay, well, how big is advertising as a percent of GDP? How big is cloud computing as a percent of GDP? How big has it ever gotten? How big did oil get as a percent of GDP? What was Standard Oil worth? What was, you're now guessing that AI stuff is going to be very big, that it's all going to be done by Nvidia and nobody else, that it's not going to be competitive. You run into a bunch of those problems. I mean, it has a good 10-year record now in terms of growth and everything, but that 10-year record is baked in for another 15 years or something just to get you to a normal sort of level. Also, it's very weird for me. I mean, I'm familiar with the company from a very long time ago. I mean, this company's been public for a very long time, and I've known what they've done and looked at the company and stuff for probably 30 years or something. So it's odd that way, obviously, that it's not something that attract people to a new stock that came public, or something they'd never heard of, whatever. So, yeah, I mean, you run out of targets eventually. Things aren't growing, so you have to keep finding other things, and the AI stuff is very exciting for people. I mean, this is all Chat GPT, I think, that caused this, because it made it in a way that people could, similar to the internet that way, something that they could interact with and have ideas about what that would mean for the future differently than something that seems distant from them and what they're doing,
Mm-hmm. What do you think about themes then, right? So you had said you think a lot of this growth we've seen in NVIDIA is investors playing, in air quotes, like a theme of AI.
Mm-hmm.
Do you think investors just see this as like the only pure play AI situation? I mean, there are investors that that will invest like with themes in mind. I mean, what are they looking for? Are they just saying, okay, I think the world is going to look like X, so therefore Y will be able to profit from it, and they're not thinking in terms of return on invested capital or free cash flow growth? I mean, anything like that? I mean, how do investors that you've spoken with in the past, when they say, oh, here's the theme, how do they typically play it?
Yeah, they buy things based on what they think the world's going to look like in the future. I mean, no one is buying this with any expectations about the numbers, because you could try to run through the numbers and it doesn't make a lot of sense. Now, the future could be very different than the past, but you have to ask, how different does it have to be? The answer is pretty different, because you've got a few problems here, right? So one, you have to have a number that multiplies, off of the base year. So each year, you have to say, okay, what's sales, gross profit, operating profit now? We have to multiply by a pretty big figure just to be able to get it to compound to a level that we need 10 or 15 years or whatever is the end of our period that we're looking at here to have value. So that we don't lose money on the multiple contraction, because you're going to have huge multiple contraction no matter what. Even if you're positive on the stock, you have to assume that. So to offset that, you need to have earnings compound at a really high rate. 2, Buffett talked about this with Cisco, you have to make up for the amount of earnings you lack in the early years on the capital that you put in. The capital that the business earns on, what the business earns on its own capital doesn't matter. It's what you're buying it at. So you're buying it today at a price that, let's say, is what, 200 times earnings? What is it?
Yep.
Well, record earnings, though, were twice as high as today's earnings, right? This isn't peak earnings.
Mm-hmm.
Is that right?
No, that's true. Yeah.
Okay. So you're paying 100 times peak earnings, let's say. Let's say it doubles peak earnings going forward. We're paying 50 times, okay? If we could get to that level. And then the conversion is pretty good for earnings to free cash flow of this company. So let's assume it's all in free cash flow. You're in 2%. Short-term money pays 5, right? You can leave money at the Fed at 5. So we have a 3% gap that you have to make up in year 1, right? And then you have to add that in. Plus, then you have to also have the compounding of it into future years to make up for the part that we were just saying. But it has both parts. It doesn't earn a sufficient earnings yield. And then it also has to grow really fast to get to the point where it would... this is pretty simple. There's a pretty simple way of doing this. It's about 10 times overvalued compared to what it should be in terms of like price to sales, price to earnings, things like that. It's roughly 10 times. We could go down. What's EV to EBITDA? All of these numbers are about 10 times too high, right?
Mm-hmm. Mm-hmm.
Right. So to get there in 10 years, we've said, you could use Rule 240. Basically, you're going to have to grow 25% a year, about 24% a year to get there into about 10 years. Or to get there in 24 years, you have to grow about 10% a year. It's not a perfect number, but to move one order of magnitude, you need to have something that two factors that together add up to, that together multiply into about 240. So, that's the issue that you have. The last 10 years, it did do something like 24% a year. It achieved that. So if it does that for the next 10 years, then you would get to a level where you won't really lose money on this stock. But you won't make money for the 10 years that you have. And you could have made 5% a year in cash right now. Now, maybe that won't continue to be an option. But so if it grows at about 25% a year for 10 years, at the end of that period, you should have a return of about 0% a year for 10 years. There's a slight earnings that you might get from free cash flow that maybe could come out of the business. The multiple might not fully contract 90% down, although that's not unreasonable. A 90% contraction. Probably at some point sentiment will change on the stock. People won't like it that much, and it will contract by more than 90% at the bottom, although on average it won't contract by 90%, but that's usually what happens. So all these numbers that we're seeing, 30 sometimes sales will be 3 times sales, 200 times PE will be 20 times PE, all of that. So a 90% contraction, to offset that, you do have to grow at close to 25% a year for 10 years. You can go longer, you could say 15 years you hold it and stuff, but that gets you to a 0 return. Where what you normally want is closer to a 10% return or something. So, and that's assuming that, it will grow by like 25% or something. Let's imagine it's only a 50-50 chance it will grow by that much. Then you start to run into more problems. So, that's also usually an issue with these things. The problem is not that if this was Coca-Cola or some of the Nifty 50, some of them, not others, and it gets really overvalued, but it has a really strong competitive position, then it's just the overvaluation that we're talking about. With a company like this, the question does become, is the future going to be brighter for them or worse? Because if you attract a lot of asset growth, then it could be worse. So what could happen is margins could get bad, overinvestment in the industry could happen if people really get excited about AI stuff, right? As opposed to situations where there's a lot of growth in it, but it's not possible for people to come in and compete with it. The issue is, can people raise money? Can people direct capital towards it? That's the worry that you have. And that's what a worry that you have with the giant tech companies, right? What if Microsoft, Facebook, Google decide that they want to spend lots of money on this stuff? What if they buy companies and do lots of things to compete? Some of it can benefit you. You can partner up with some things and benefit from some things, supplying things. Some of it can be a competing standard for some stuff, right? So a lot of times people just think it's the price, but it actually turns out to be both. Like when I talk about Microsoft was just the price. So, going back 15 years, 13 years or something, it just got very cheap after it had been really expensive in 2000. Cisco was not just the price. Cisco's been a bad business performance for 20 some years because providing the infrastructure of the internet turned out not to be that great a business. There was a huge amount of overinvestment in the early years of the internet, and then there was too much, and results just it hasn't been a growth company since then. So they got it wrong. I mean, I mentioned that. Like, if you took Cisco and a railroad in 2000, everyone thought Cisco had the bright future, the railroad had the bad future. It turned out that was wrong. If you don't know what the stock prices are, it's actually the reverse of that. The business climate would be better for the railroad over the next 25 years than for Cisco, because there was no more competition going into railroads, right? And there was only competition going into internet. It turns out that we had vastly overbuilt internet stuff. Everyone had way too much inventory. Everyone had way too much everything. And it took many years to fix that, So, and that's with the internet turning out really better than a lot of people thought in terms of how quickly things were adopted, how quickly, if you had said everyone will be streaming this and we'll have these smartphones and this and that we had already done too much that way. So, we'll see, but I don't see, it's very hard to believe that this stock could do anything other than lose you money over 10 years or something.
Mm-hmm. I mean, do you think the people that are investing in this, I don't even want to say investing, or maybe they are thinking they are investing in it, it's almost like they're just playing the movement, the momentum, the beauty contest. I mean, do you really think they're planning to hold this for 5 or 10 years, or think that, it's going to generate free cash flow and then pay me a bunch of dividends or anything like that?
I don't know people who think that way, but like I said, there's people who need to find something a lot of the times. Right. So if you need to find something, there's maybe not enough stuff out there to find. To some extent, it's who controls what money and where it goes that decides what goes up and down. So if people want to put money into something like ARK as a fund, it's going to drive up the prices of those kinds of things. If they want to put it into value things, it's going to drive up those. It's the same as with our fund, right? Like, if people pulled out half of the fund, that would have an influence to lower the price of the stocks that we like, because we'd be less likely to be buying those stocks that when that demand comes out of the market, and the same amount of supply is there and stuff, those stocks would tend to drift down. If people doubled how much they invest in our fund, it would have the tendency to drive up the stocks that we like. So when you talk about like the Nifty 50 and all of that, a lot of it is that was their strategy. It's not necessarily that everyone adopted that, but they gave money to people who said this is a good strategy to buy only the best companies. I don't know what most people do like the people that we talk to are a small subset. I know what the media covers and what people like to talk about. I know that people who don't invest and who talk to me because they know I invest, outside of this podcast and emails and people like that, but just in the world, are going to talk about Nvidia. They will know what the stock is now, just like they'll talk about crypto or something, or the debt ceiling, right? They would know that there's things about that, but they don't know about lots of other things. And here, these are things that they will know about. They all know about ChatGPT. I think that's what changed everything.
Mm-hmm. I think only 10% of the population has interacted with ChatGPT, but that's still pretty. I would say it's a lot of people, considering it just came out a few months ago. 10% of United States population or global population, I forget what it was, probably United States, have used it. So, yeah. The whole debt ceiling thing, people have spoken to me as well about it. I mean, like family members and stuff. And I'm like, it's in my eyes, I mean, right or wrong, America's, constant use of debt, whatever your opinions are to that, it's in my head, like, as it relates to markets, it's going to be a nothing burger. Like, it's going to get passed, and just like it has the past, how many times they've done this. And I don't know, I just, we talk about often deciphering between the signal and the noise, and the amount of noise that happens every single week in the Wall Street Journal. This will be another example where 2 or 3 or 4 months from now, you could read the newspapers and the financial blogs that are talking about this as if the world is going to end, and you'll be like, wow, that was a lot of energy focused on nothing. I mean, it's politics.
Yeah, and they they prepared to write these articles, right, about what would happen and explaining and breaking down, and then they don't get to do that. So that's also part of it, right? What what things are covered that way and what things people will click on and all of that. So,
you believe that the U.S. is going to like default and threaten their sovereignty to the rest of the world? Get out of here! Come on, like why even spending time thinking about it? Right or wrong? I'm not debating that, but I'm just saying like they're going to raise it and life is going to go on. I mean, there'll be something else to complain about.
Yeah, well, the thing is, how do I put this? I provided information for some articles sometimes. I wasn't allowed to be quoted. I said you can't quote me and stuff, but background for stuff. Some reporters asked some things and stuff years ago. This happened more often when there were fewer bloggers and stuff. But one thing I realized very early with dealing with reporters, they didn't really care if they could explain it honestly. They cared if they could quote someone else and cite it, right? So if they could cite something else, then they didn't have to worry about it. So if AP had said something, then they can cite that, and then that's the end of it, right? And so the thing about both the bank failures and the debt ceiling stuff is that they can tell very scary stories, which are true. They can say, here's what would happen if this, there's no guarantee. Those uninsured deposits are not guaranteed. There's no guarantee that they won't default on the bills on such and such a date. In fact, they can walk you through how exactly they could do that. It's unlikely that they would do that, but it's not unlikely because of some mechanism in place that would stop it. So they can walk through exactly how it would happen, So I think that that's very appealing to them, as opposed to situations where there's a lot of uncertainty about it, and of exactly what bad things would happen. They like things that are very certain of exactly what the risk would be. So in these, the percentage risk might be really, really low, right? But they can describe exactly what would happen. What happens when you default? They can write an article about that. What happens when the uninsured, there's no law that's saying that the uninsured deposits will be covered, even though the insured ones will be. So what would happen in that scenario? They don't really go back and say, okay, this has happened how many times and how many times does it not happen? So what do we think is the probability that it wouldn't happen? And also talk about, okay, what could then, so instead it was like, what's the exact day that it's going to run out? What's the exact, So instead of how likely it is, like they make a big deal about, like, Hollywood had a writer's strike and stuff, right? They make a big deal about that every time this happens. But it's actually a pretty high, if they ask people who know in the industry and stuff, there's a pretty high likelihood that there'll be some sort of strike or something in those cases, right? Because the consequences aren't that severe for short strikes and things. It's a normal part of these labor things. Whereas the consequences are really severe for this sort of thing, and it's not that likely. But they don't tell you the probabilities of it. They just describe the scenario for you. So they're not that worried about how likely is something to actually happen. They're a lot more into how precise can I be about what would happen, how bad it would be, or how good or whatever.
How do you think about probabilities then? So like what odds or what probability would you put on, for example, them raising the debt ceiling, and then we just go back to complaining about something else, right? Like what probability would you put on the sun setting tonight and the sun rising tomorrow? I mean, level of confidence, 100%. Is anything 100%? Could a meteor or a black hole, we talked about black holes last week, somehow open up and suck the world in and consciousness is gone forever? I mean, when you think about when you think about probabilities, how do you generally think about like, hey, is there anything that is a 100% certainty? Or
right. There's almost,
Go ahead.
There's almost nothing that's 100% certainty, right? But there could be some things that are pretty close. We can think of things like, we've talked about standard deviations and things like that. The issue is usually the way people model it out is harder instead of as fuzzy as the real scenario is going to be. So like in the case of the debt ceiling, I would not put 100% probability that a specific bill would mature and be paid off on that exact date. That was somewhat risky. So that there could be a failure for a period of a few days that something would happen with bills that were due at that exact moment. Yeah, I probably would be hesitant to write insurance that guaranteed a payment to someone under that scenario, even if they turned out to be made full a week later, right? Because there could be some technical trigger of that. But that the whole world was going to collapse and the U.S. wasn't going to raise more debt in the future, you know, that it would be locked out of markets and stuff and downgraded permanently and things. No, that's a lot less likely. That's more certain that that won't happen. But a technical default on something because of negotiating tactics and things, you know, that was possible. So where usually people would break it down into will it happen or won't it happen? I'd say it's a little more complicated than that. You can usually have more confidence in certain outcomes not being so bad for some things. So, you know, there's somewhat less confidence that one bank wouldn't fail in a way that wouldn't pay the uninsured at all. Although I've said that, you know, that it's basically covered. If you look historically, it's always, that's the way it's been handled and everything. And Buffett said that. It is possible, like a Lehman type thing or whatever, it is possible that there's sometimes one that would happen, you know, because of political arguing about it, because of people can't share accountability for it of who makes the decision. Two people both are saying that I'm not going to make the decision, you have to, and, you know, technical things happen and something fails. It's possible, but it's not possible that 100 would fail that way, right? And then people wouldn't do something about it, that it would be intentionally done for a long period of time or something. So that's why when we talk about that, we just say, like, look, you just have to, if you're a lot safer than most other banks, you won't be the first ones to fail. You don't have to worry that much about this because there's not going to be a huge number that fail that way. So I'd have much higher confidence in something like that than something else. But, you know, it depends. But like when people ask like nuclear war or something, I have much higher confidence that there wouldn't be the kind of prolonged nuclear exchange that people expect of responses from major powers back and forth. But I'd have very low confidence that one event would not happen. You know, so there's a much higher probability of one weapon being used than I think people realize, but a much lower probability of a back and forth exchange. Because people immediately assume that if that something like that would happen, that definitely if A happens, then B would happen, and C, that people would actually follow orders and that they would actually carry out these strikes back and forth is just a lot less likely than people assume. But that one event might not happen because of a misunderstanding or something is probably more likely than people assume. So there's lots of cases that fall into that. And that's what I mean with like the technical default aspect of it. People may have, I think when the probability comes very close to 100%, people are sometimes a little too confident in that. You want to be careful of that that's a 97% probability and not a 99.5% probability or something. And for major things like that, I think it's important. I would be cautious about writing insurance that there would not be a technical default or something. But I wouldn't be cautious about not buying, like Berkshire did, not buying debt that they think will be worth a lot. You know, that yields too much because it was close to the cliff. So those are two sort of different things. But like, because you wouldn't be paid that well for the insurance, you know.
Got it. Cool. So speaking of Buffett, we can bring up what we've been talking about basically weekly here. He continues to buy more Occidental in the open market. Says he doesn't want to control the company, isn't interested in acquiring them, but is happy to own their shares and continue to buy more stock. His Form 4 came out yesterday, and they bought more stock between $58.30 and $58.85. Looks like another 4 million and change shares, which is probably like what, the $200 million range. So he's continuing to buy Occidental, Geoff. Do you think he's like sitting there and saying, oh, the rig count is doing this and production is doing that, and I think oil prices are going to be higher, you know, this year or next year, and China's coming back on and demand and airlines are busy? I mean, do you think he's sitting there thinking that? I mean, we've talked a lot about the capital allocation aspect of this, but I'm sure he has some sort of macro view on oil prices?
I don't know. The last 2 times he did this, inflation was high. So he may respond more to inflation than anything else. Inflation got a little bit high for the modern period in the after 2003, before 2007 or something, right at the, actually in terms of probably CPI and stuff, peaked right when the collapse happened in the financial markets, starting in summer 2007 or something. And then he did it, with the 70s inflation stuff. So yeah, I mean, they're pretty cheap. We looked at them and stuff. U.S. oil companies, U.S. oil reserves and stuff are very attractive versus the kinds of returns you can get in the stock market, because these are pretty well real protected things. Now, like we said, these are shorter life assets than they used to be, so they're not as well protected. You have to reinvest in Capex and stuff much sooner and find new oil and everything. But they have pretty good returns if you think about the fact that these are more real returns than in inflation-adjusted terms of other things. So, but yeah, getting pushed into that kind of stuff. A lot of businesses aren't that good with the plenty of inflation and everything, so he may be tempted to do that. He's done some inflation hedge things before, so they haven't all worked out. But oil, some metals, things like that, he's invested in, whether it was the 70s or later.
How would you think about the valuation of Occidental? So a business that is tied so much to the price of oil, right? It has a enterprise value to free cash flow on QuickFS of 6 times. They're buying back stock, I believe, paying a dividend as well. Yeah, they pay dividends. How would you think about that, right? If you were to plug that in that Excel model brain of yours, how would you typically be thinking about what the valuation could be or what it's going to earn for you going forward when it's so tied to the price of oil?
Well, you just have to accept that you could make a lot more money or lose a lot of money just based on the fluctuations in the price of oil that are fairly normal. I think $70 a barrel real is what I would use. However, I think that $30 a barrel is probably a normal sort of variation that you would expect year to year in the price in normal years. So, like we're always talking about standard deviations and things like that. So I wouldn't be surprised if 2 out of every 3 years you end up with swings around $30, sometimes bigger, sometimes smaller, but that's just typical. Which means that a range of $40 to $100 a barrel is, just what you should expect when you invest in it. And actually it could be bigger than that. Over longer periods of time, there are going to be some extreme swings that are outside of that. But just business as usual, $40 to $100 a barrel is probably to be expected. You shouldn't get overly worked up if it drops as low as 40 or rises as high as 100. And a lot of these businesses are so levered to the price that it would be a really good investment at 100 and really bad at 40. So that's unavoidable with these. I mean, they can hedge and stuff, but when you invest in them, it's not as predictable as some other businesses that way. They could lose money in some years, and they could make a lot of money in some years, and it's going to have to do with the fluctuations in the price. But, theoretically, probability-wise, like we said, if you're doing some calculation of expected value, you should just plug in the number that you think is the correct price and then go with that. And so you can't be so precise that you say, okay, how will it survive on $40 a barrel oil? You just say that could happen. I could lose money if that happens. But I also have some probability of 100, I have seen no reason to expect, I just don't have evidence to say that there's more risk on the downside than on the upside or something. So you basically should just buy it on the price that you expect a normal level to be. And that's how we look at companies like that, and I think that's probably the sort of thing that Buffett would look at. The capital allocation is very important, though, because on an ongoing basis, it becomes more of an issue if it's not returned to you. It's easier to do the calculation if the money's returned to you or something. So, and buybacks function much the same way. That as long as the stock is cheap, they're even better. So buybacks and dividends are helpful. Paying down debt, you can calculate what it's worth, but it's probably not worth doing it. All of them are doing it, but it's bad because you're taking out real assets that you have that Buffett obviously thinks is cheaper when he'd be buying the stocks, and you're using that to pay down nominal debt that you would have out for a few years. at real rates that are like nothing. So that's obviously not good. But the fact that most of these companies are not acquiring other companies and doing a lot of capex and stuff. There's been some acquisitions, but they're usually of smaller type companies that are in certain, there was one couple $1 billion company, right? It wasn't that big, that was acquired recently, which falls in this sort of space. So I wouldn't be surprised if there's a little bit more of that kind of thing. But I think that was an all-share deal, and I expect lots of that kind of thing because they can't agree on price.
Why do you think there hasn't been as much CapEx spend in this cycle? Is that more so of like a political thing, or?
Yeah, it's interesting. I mean, they were burned badly, so you can't overlook that. Why are people piling into Nvidia? Because, that stuff, every time there's been a dip in speculative things, it's picked back up again, right?
Mm-hmm.
So people didn't feel that way after 2000. I mean, at first they did, but by 2003, they didn't. I mean, if you lived through that period, there was hope a few times, and then there was not. So people were done with the internet and stuff by like 2003. But in 2000, 2001, they weren't. They thought this stuff was going to come back. But the fact that it never came back and kept going down is what bothered them. Same thing here. So about 10 years ago or whatever, they had a period that was bad in terms of debt and also in terms of how high prices got and came down. And some of that is also that, remember that we're talking only about oil, but a lot of these things also had meaningful natural gas. The natural gas thing was even bigger. So natural gas is cheap, I should point out. Oil is not, but natural gas is. So, that's an interesting thing to think of. Everyone wants to be in oil now. But it is worth mentioning that I don't think oil is particularly cheap, but natural gas is very cheap. So that's one thing to keep in mind, because all of these, almost every single company says they want to be more oily and stuff as part of their presentation.
Why do you think the capital allocation ethos has changed, though? Is that because they have a bunch of capital and they aren't going to put it back into Capex, and they know that investors will reward them more if they return capital to investors?
It's possible, but I don't really think so. I think it's that it was so bad a decade ago. I think if they didn't go through that this wouldn't be happening now. And we'll see. I mean, the prices aren't crazy on oil. If oil goes to, similar to, so if we talk about like what oil was at the last peak, going back 15 years, whatever, we're going back now. We'll be talking about like $200 a barrel oil right now, or there's different types of oil and stuff. But if we're talking Brent or something, we'd be close to that. So I think if oil went there and stayed there for a little while, we'd hear a change in the narrative, and they start talking about sure, there's been a change in terms of, if you're talking about like, has there been a change in terms of ESG and all that? Yeah, it's hard for me to evaluate that. There has been. I don't know how big that is, though. We'll see. There are lags and things. They're big lags and things, and I think that's this thing with Nvidia that we're talking about, and it also could be the thing here. It's not. It doesn't happen overnight, right? So we've had interest rates that are above that level now, and yet that's not consistent with where Nvidia is, right? That wouldn't make sense to people why that would be happening. And yet on the other side, you have these things which, some of these companies, their free cash flow yields and stuff are good. They're taking some of them are not really growing reserves. So you're getting all of it in earnings each year in cash in some way. Now they could go and buy things or pay off debt or whatever, but basically you're getting yields that are attractive on it. And that makes them really cheap. But we don't know how that will work out. They could be disliked because people think that prices are high now or things are going to go down. Obviously, there's a possibility of a recession, which normally, momentarily at least, would have declines in oil prices and stuff. But I think a lot of people benefit from having some oil in their portfolio, because it can do okay in inflation, and more than recession or something, what's really bad for stocks is a lot of inflation. Most companies that you own probably don't do that well in inflation. Like, they can't get their returns on equity up. And so you now have overpriced stocks that are going to have poor returns on equity in real terms, which is not good. So, that would be pretty good. People don't want it, but I do think that both banks and energy, both financials and energy, that are, like banks that just earn on interest rate spread, and energy companies like oil companies in the United States and stuff could be a diversifier for you. So when you find an attractive thing like that, it wouldn't be bad to buy that kind of thing, because at least it's not similar to other stocks that might be overpriced and that might be in your portfolio. So if you can find something you like specifically that way, I don't think it's a bad idea. I think it helps. Yeah.
When you think of like a normal price for oil, I mean, do you account for the fact that oil consumption worldwide is basically grown every single year throughout both your and my life, and is probably going to continue on in the future? I mean, even in the biggest like oil demand shock was in 2008. I think it was down like 2% in 2008. I mean, it's basically grown every single year for the past, I don't know, 50, 60 years.
Yeah, here's the thing. I'm different from everyone on this one. I don't think that's particularly important.
Okay.
I think oil prices could be a lot higher with way lower oil demand. We talked about the life of these assets and stuff. I've talked about how much excess production I believe OPEC really probably has and stuff. I think people may be overestimating how much swing production you can have in lots of things. I think that if there's significant need for capital spending on things, if there's significant need to invest a lot, then you will have a situation where the price is going to reflect how much it costs to put on a little extra supply in those situations, or to take it out. It's similar to like return on capital when we talk about things. Everyone always talks about like, oh, how will this get better if demand doesn't go up for it? It's actually not the way they usually solve a return on capital issue in an industry. Usually the industry shrinks. Mm-hmm. Like, that's how you solve it. Demand for coal goes up all the time. It wasn't good for the coal industry. Yeah. It's not like their returns were higher from 1930 to 1970 or whatever when demand went up than from 1990 to today when it went down. Now, some went bankrupt and stuff. They took on debt and everything, and that's what can happen to these companies. They can't adjust. It's a flexibility issue. I agree with that. But if you look at the asset life of a lot of these things, if demand declined, they could take out supply very quickly. We could be talking about a situation where much of the company could be gone in 5 years for some of these companies, some of the smaller ones that we're talking about and stuff. All it would require them to do is just be willing not to put more money into the business. So, in terms of the oil consumption stuff, that's more complicated. I mean, I think it's very price driven, very, very price driven. I think the United States would, if we had been able to find supplies of oil cheaply from the 1970s today, would be consuming a lot more oil. We'd have a different economy than we do. It wasn't assumed that we could reduce how much intensity of energy we had, but we did because the price changed. I think if it was very, very cheap, then you would just use a lot more of it. And so they have all these things about global warming and everything, which brings in questions about what will happen. I think it's hard to know. It depends on whether people are willing to channel capital into this sort of thing versus something else. And it also depends on interest rates for lots of the other things. Most alternatives, like all alternatives, to the system that we have set up in terms of high consumption of oil for energy purposes, for things like using as fuel in cars, is set up that doesn't require a lot of capital spending from this point on, as compared to other methods that you could use, right? So let's say you want electric cars, and let's say that you want those electric cars to be powered by a grid that gets most of its power from things like wind and solar and stuff. Well, that's what is the price of commodities, and what's the price of money? What's the price of time? Because that's a huge amount of investment up front in a lot of Capex, both for the cars, but also for building out all these plants for this stuff. which is not required at the same level and for the same lifespan. These are very long-lived assets for the dirty stuff that we're talking about now, as opposed to that clean energy stuff. So we'll see. But I think if you had very different real rates and stuff, we might have a totally different attitude about this. We've had like real rates at nothing for a long time, which is probably what's driven a lot of the green energy stuff.
Well, we've talked about coal, we've talked about oil, we talked about ESG being a bit of a scam at higher interest rates. Why don't we just piss everybody off? So what are your thoughts on nuclear and uranium as a alternative energy source? There are uranium stocks, as you know. Do you have any general thoughts on that? You have a view on that?
No, that's a complicated, uranium's like silver and stuff with Buffett. It's a complicated issue. So there's a few problems. One, there's plenty of supply that you can get from other sources. It can just be expensive to bring it online and stuff, and so you would. And we don't know much about it in some places from where it comes from in the rest of the world, so I'm always very skeptical of that. You can also repurpose some stuff. So for a very long time, we had, and actually we mentioned a stock, BWX Technologies was big in this. Mm-hmm. Obviously, since the Cold War, it hadn't been necessary to do much mining and stuff of uranium because you could downblend for civilian purposes from things that have been weapons grade. Obviously there was a huge amount. There just has, since the 1990s, there hasn't been need for new production net of weapons programs around the world because they had more than enough. And so they've invested in some stuff to keep some things fresh and stuff in that. But basically it's lower than replacement level. So that was historically where a lot of it came from. And then, the question is, of course, some of these countries may not be that friendly to the United States and stuff that would have uranium. But I mean, this is something that I don't expect to be big ever, nuclear. It's fascinating because it's obviously a technology that was very successful, very effective in what it did, and was abandoned for various reasons, including concern because of the extent to which it was used in weapons, right? That was a big part of it. So it was abandoned partially for that, partially for political, social reasons and stuff like that, but a lot for capital reasons, that regulations were really high while you were building a plant. They changed while you're building it. It got very expensive, and then it was expensive to borrow the money and stuff. So civilian nuclear power basically, it isn't built out anymore, and many interesting plans on that never really were developed the way that they've been planned to, and never operated at the sort of levels that they were supposed to and everything. Not just in the United States, but like France experimented with some stuff that they never really operated at anywhere near what it was supposed to for a long time. And so you got that, but you also have space flight, right? I mean, we're flying around in chemical rockets, right? Which makes no sense when you have nuclear power, but we won't use it because we won't, because agreements between the United States and Soviet Union and stuff, and just general principles on that of not introducing nuclear stuff for space program things. Because of that, it was easier to do that deal and to work out those principles than to be able to go to these different planets and stuff, which would not be difficult if you use nuclear. So, it's interesting that you can have a technology that seems that promising and then abandon it. But it can happen when it's something that's as worrying as that to people. So, we'll see. But I mean, that can happen with the ESG things too. I mean, you could have technologies that we're talking about, whether it's, it could be that coal is the cheapest way to provide power in this country. In the United States and stuff, this is not a big... I mean, if the United States wants to not have coal, it can not have coal. But they can do that pretty quickly. If the government wants to work towards that, if whatever. I don't just mean that you expect the prices of things will be the same and it'll happen overnight. But if that's an actual priority, it's not difficult to achieve. In some other countries, it is. Some developing countries and parts of the world, it would make a real dent in their quality of life and stuff if they weren't able to produce using certain kinds of power and stuff. And it's more issue for them, I think.
Got it. Well, we can continue on and talk a little bit about special situations. I want to bring those up more on the podcast because, it's interesting to talk about things that are, happening that are technically not correlated to the market. There's, corporate developments going on, corporate change. And we can talk about Seritage growth properties. The stock currently trades at $7.42. In their Q1 earnings report, they sold 27 assets for $291 million, and has 15 assets without due diligence contingencies under contract for another $295 million. And then in that PR from their earnings release, they said that they have 4 more assets with standard due diligence under contract for $37.9 million. So I had come across their earnings report this weekend. I was just looking around at some different things. And then I think it was Tuesday, since Monday the market was closed, they issued a press release. So yesterday, that they made a $200 million prepayment to Berkshire on their loan with them, and said that that will reduce total annual interest expense by about $14 million per year. Management still thinks that they can get, I believe, $18 to $20 per share in a full liquidation. The stock, as I said, is at $7.42. It's got 22% short interest, which I thought was an interesting piece to this puzzle, because, who knows what could happen with that. But, $18 to $20, management hasn't haircutted that at all since rates have gone up. And so they still feel confident in that, and the liquidation continues on. So just curious if you have a view on that, because there's a pretty big spread between what they think and what the market currently thinks.
Yeah, I followed this one a little bit. The first thing we should mention is there's also preferred stock out.
Yeah.
So there's Seritage, which is a large, what's the market cap say? It's on Seritage, 400 some million. Do you have it there?
Yeah, 425 million.
425, yeah. So I think we can go through the enterprise value a little bit here. This is my guess of what it looks like in terms of the prices it trades at. So common stock, the loans will be at, face. But common stock, we just said is going to be over 400 million. So you're in the 400, 450 million range with that. The preferred is a pretty small issue. I think it's 2250 or something might be the price, in that neighborhood. It's been around there. 2.8 million shares, I think, is my memory of how many preferred out. So let's say it's like 60 million or something in that neighborhood, right? So maybe 420 million or something on the stock, 60 million. We're under 500 million in the equity portion, right? And the common stock being 7 times the size of the preferred. And then you have, if they paid that 200 million down, I believe that was 800 million less 200 million is 600 million, right? Yeah, so 600 million. So you have somewhat less than 500 million in. So we could kind of divide into 3 pieces, right? You got your senior piece here, which we just said is 600 million. That's entitled to the first payments and stuff, right? That will be the safest part of the structure here. Then behind that, you've got a small slice preferred. That's 1/10 the size of what they owe Berkshire Hathaway life insurance or whatever. And then behind that, you've got the common stock, right? So saying that so let's say it's 1.1 billion or something in that neighborhood. So about 2/3 of the way into that structure is where you have the preferred sitting, right? Because you got a little more than 60%. Let's say it's closer to 70%, around 2/3, somewhere in that neighborhood, is going to be your loan. And then in between that is this small slice of preferred, which is only going to be 5% or something of what we just talked about. And then behind that is going to be all your common stock. So while we talk about it like, oh, if it doubles or if it halves from what these payouts are expected, right? A small change in the enterprise value is going to change the value of the stock by a lot more. Maybe not quite 3 times, but something like that. So if we say that there's a 10% decline or 10% better than expected performance in terms of the sale of these land and buildings and everything, that's going to move the value of the common stock by almost 3 times that. Let's say at least 2.5 times. So, a 10% move is a 25% move and that kind of thing, right? That's less true of things that are further up that we just talked about. So, certainly, I mean, the first thing is the preferred is interesting because the preferred basically is giving you a return of, let's say, 11 or 12% a year or something, because you're getting your 7%, but then it's at a slight discount. Let's say it's at maybe it's selling at if I said $22 instead of 25 or something like that, 25 is par. So maybe it's at 90 cents on the dollar or something. I don't know the exact price. And with that, you get a slightly higher yield. So maybe you get a 7.5% yield or something. And then also if it takes, let's say 2 to 3 years for this to go through, we don't know how long it'll take, but let's assume that should add another 3.5 to 5.5% or something. Depends on exactly what you pick. A little less than 2 years, a little more than 3 years, whatever. But in that neighborhood, you've got 3 to 5% or something. So if you're getting over 7%, let's say 7 to 8%, you're getting 3 to 5%. You put those numbers together, you're getting in the neighborhood of, depending on what day you buy the stock and stuff, 10 to 13%. If you're interested in the common, then you would think that the preferred is super safe, because the preferred is going to get that money even if the common gets nothing. And this has been taken over in terms of running the sales process by someone who did the Luby's sale. Mm-hmm. And like you said, they put out numbers to say this was the original. Now they haven't updated those ranges. They've just not talked about it since then. So they said, there's uncertainty about that and whatever. And they covered the ranges that you mentioned before about what the payouts might be, but not since then. So you got big upside in the stock, but maybe you have some certainty in the preferred. But unless you have almost total certainty, I don't know, do you want to buy something that is low double-digit returns? Whereas with the common stock, you could have the possibility that you could double or something, like you said.
So you're saying that you would rather the common stock because there is less certainty, but you could basically make up for that to double or make a 3 or 4 bagger on your position.
I think most people would want the common stock if they were going to do this. The common stock's a lot bigger, right? Mm-hmm. So I think it's like 7 times the size in terms of price, but I also just think it has more volume on it. You mentioned the shorting, which might also cause some volume stuff. Let me put it this way. I would not short the common and buy the preferred. Now, I'm not recommending it, but obviously there's preferred out there if you want to be short something else and long something, but I definitely wouldn't recommend that. I would be more comfortable with the preferred probably, to be honest, because there's a lot of debt. There's a lot of debt, and there's not a lot of assets over that debt. So we're going to be close to, does the common get anything? And if it gets something, what does it get? Even in situations in which, let's say, the common is worth double what it's trading at now, right? Still only about half of what's going to be paid. I mean, it's a little bit more than half, but it's not a lot more than half of what is going left to be paid in terms of what they get for these assets. And it's quite a bit less than half of what these assets were not that long ago, because they've already sold those down. So you're still dealing with a situation in which even a good outcome for the common's only like half. We're talking about the back half of the payout. So we're easily doubling the riskiness of this. And then I assume that other people know a lot more about commercial real estate stuff than I do. And so, we talk about, being at the table and who's the patsy. Definitely I am in this case, right? So I know less than they do about this. I'm sure everyone in the stock knows more about commercial real estate, knows more about the situation and everything. It's not a deal breaker, because you could be in a stock where their emotions get the better of them, whatever, and you can still be in something. There's plenty of cases where you're in something where the other people have more information than you, but you can make the more informed decision. But it's a risk here. There's what tends to happen in most markets, right, like this, is that prices don't get moved fast enough. So, we'll be talking about hotels or something, you and I, and say like, well, they keep saying that they're not seeing a change on the price of it or something. Interest rates are 0 to 5 and they don't see a change. Yeah, but they haven't sold any. So they have seen a change, and that volume disappeared in the market, but the mark will come later, right? We talked about that with Timberland. Eventually, that QAnon was sold and everything, but same sort of thing. Basically, the market dries up. So that's possible, right? Those risks, that these things are going to get marked down a lot. And then the other thing to keep in mind is I mentioned once that I've only once in my life lost money on a net. All other cases I made money on a net, right? But it was a situation like this. That's the thing to keep in mind, is that it was a liquidation. So I don't think I would have lost money in a net that wasn't a liquidation. It was because it was a catalyst, it was liquidating, it was doing it, that my standards were lower. And there is a question here to ask, is this just because it's an announced event catalyst that people are interested in it? Because is this better than Maui Land and Pineapple? Is this better than Alico? The debt structure of Alico is pretty nice compared to this, right? And then think about, like, just some other things about how, what is the price really versus, what's the price really versus, and the other thing with this is we'll see how they're, we've seen how they're doing it, but part of it also is that this stuff doesn't generate cash flow for them, and probably to get the best sales price, actually they should put money into it, which they're trying not to do and stuff, but it's not as good as owning a bunch of raw land, right?
Sure.
I mean, that's part of the attraction of whether it's Alico or Maui Land and Pineapple or something, is that if you can sell it to someone to develop it or something, that's fine, but actually it holds its value pretty well and stuff between those times. These are more of a drag on you that way, or a temptation, right? So I think I follow people who are in it and stuff, or who've sold it. There's suddenly been a lot of pessimism around it, it seems.
It's because rates have gone from nothing to what they are. I mean, mortgage rates are 7%.
Yeah, but here's the thing. The preferred, I think, traded as low as 13 or something and as high as 23 in the last year. Again, small volume and stuff, but it's not like it's no volume. I think, I don't know, I might trade 20, 30, 40,000 shares on some days. So that's plenty of volume. Though very small versus Seritage, common, but that shouldn't really happen, that you should have the preferred near par now and the common have dropped from, wasn't this a $12 stock a little while ago?
We could look at
it's been down cheap before, but this has happened this year that it got cheaper.
And the
there
last
was a
year
lot of
was at
pessimism
12
before. Yeah, that's the part that I'm talking about. Yeah, so it's basically in the last year. You can't pull up the preferred on the OTC markets reliably. There's almost no place to do it. You can pull up the preferred, but I can't get a good chart of the preferred versus the common. But I just should point out to people that shouldn't happen, right? I just read you the structure. The preferred is quite small. It's like, I think it's 60 million. And you have that $600 million loan in front of it, and then you have this 400 some million behind it. Maybe people are threading that needle really narrowly, and they're sure that the common is going to recover, but it's not going to recover near the 12, There's a lot for the common to absorb of losses from the stock price it's at now before the preferred is impaired that way. But it is interesting to me that in the last year, the preferred used to trade at a much lower price. People were concerned on the preferred, and it's not now. It's just interesting because if you think about it with the stock, the risk of getting nothing should be a big part of the price. Because we talked about this, like, just mathematically we could do this. What's the chance that it can get? So, when valuing these things in theory, what it's supposed to be is the frequency of the outcome, positive outcome frequency, the negative outcome, right? We take on one side what event we think is going to happen and what the magnitude of that is, what's going to be the payout that we're going to get that way, one way or the other. And then we do that on the other side. We compare the two, and those are the possibilities, right? So when we do, and then you adjust for like time and stuff, so your opportunity cost, basically, you compare it to other things. But put that aside for a second and pretend this was happening instantly. When they came out with their original range, what was that range for the payout possibility?
I've been using around $20 a share, $18 to $20.
Okay. $18 to $20. And what's today's price?
$7.42.
$7.4. Okay. $7.42. So let's take $15. $15 is more than twice $7.42, right? So at that percentage, we'd be saying that's implying something close to that you're getting a 50% chance of $0 and a 50% chance of $15. That's not exactly what it is, because we talked about there's the time issues, and then there's also obviously chances that you might get more than 15, and there's probably a lot of chance that you might get less than today's stock price, but more than 0, right? People are probably counting on a lot more than 0, or a high probability that you get something, especially because the way this is set up, like we said, with who they brought in and what they're doing, it won't be pretty if they end up at 0. So that's kind of, if you think, 740 is kind of close to a 50-50 chance of saying maybe it's 15, maybe it's 0. I just don't know enough about what the properties would be worth and when they would sell them for that. They've sold some at cap rates that would be a concern. That 15 doesn't seem realistic to me. But it depends on the order that they're selling them in. And also if things get better or worse. If things get really bad with the banks and a recession, they may have trouble winding this thing down. Right? So that's an issue. Also, Berkshire might be happy to, Berkshire might be willing to take payment in some other form if they really can't even pay off the preferred. Because my memory now is that Berkshire is their only creditor, right? Really?
I believe so, yeah.
Yeah. So, Buffett owned the stock personally, right? Mm-hmm. Before this, you remember? So,
do you think he sold his personal stake?
I don't know if he sold his personal stake or not. I guess we would know that because if he had crossed over 5% and stuff, we would know.
Is he mixing business with pleasure?
Well, he did. They did the investment in the loan after he owned it personally, yeah. Mm-hmm. Which was a surprise to me, because normally he wouldn't buy it personally unless he knew that Berkshire couldn't be involved with it. But here there was enough debt, so that was the thing that was good about it for them. There wasn't enough stock to buy up a lot of stock, so he thought the stock was too small for them. Mm-hmm. Yeah, so I think it's a much lower. So when we compare this to like merger arbitrage deals and stuff, there's a much lower probability that this works out. There's a much higher probability that you make a lot of money. Now, there's a much higher payoff potential here than we would normally ever have in a merger arbitrage thing. But merger arbitrage, we talked to someone at the Willow Oak event who runs a website on merger arbitrage and things like that. And he went back and looked at 2,000 some deals or something that he's done since the start of the website. And for announced events for that stuff, the deals closed about 95% of the time. I think the worst calendar year, still 90% of the deals closed. A third of the deals that didn't close for antitrust issues, for regulatory. So that gives you some idea of why, like I say, Spirit or something, is interesting. Or when we talk about Albertsons or we talk about Activision, remember that even when the probabilities are much worse, than even when they're really, really on bad cases where people say this is a very bad deal compared to the probability that a deal normally happens, the deals happen at such high percentages that you could be a lot less likely, right? You'd have to be 10 times less likely to close to be a 50-50 chance. The other thing is they don't drop that much in price. That's the whole point of the thing where I mentioned Spirit. Spirits may not drop at all. Albertsons, it depends on how they do running the company. It's a little more up in the air about, their recent results were good, but like longer term, are they really that comparable to Kroger operationally and stuff? But same thing. They may not drop a lot. It's not a crazy price. Like the price that they're trying to do, the price at which Spirit trades and the price at which Albertsons trade are not expensive at all versus peers in their industries. The price they're getting bought out at is higher, right? So the deal actually closes if it closes, would be at a higher price. But the unaffected price or whatever could be really close to the price at which they trade. So I'm saying, what if there's So like say that Spirit is 10 times less likely to close than most mergers. Okay, that would be a 50% chance it closes. Say it's much worse than that. Say it's half of that even, that it's like the worst deal that you've seen that way, that there's a 80% chance it doesn't close. The 20% chance it closes is probably enough to make the stock worthwhile for you. Because there's also things with paying them off and stuff. That's also part of the thing with the preferred is then you also get the 7% or whatever while you hold it. Yeah.
Is there a liquidation that you prefer? So like the net, for example, the only net that you've lost money on that was a liquidation. Right. You don't have to name the company, but what was the type of business?
So it went into the financial crisis, killed it. Yeah. So it had to liquidate inventory basically. And it couldn't do that during the financial crisis, and it couldn't get financing. So, which could happen here. If we have something happen here that is the same as the financial crisis, the recovery for Seritage could be nothing for the common. Yeah. If we have a recession that isn't like the financial crisis, that would be different. But it's also fascinating because, like, if you look at that stock dropped a while ago. Like we said, the preferred was up. The stock dropped a while ago. And then the stock wasn't as responsive as I'd expect to the bank failures. Because, commercial real estate stuff, the buyers probably, I don't know. But I would guess the buyers need commercial banking stuff that's sort of regional banking, local banking, to do these bigger deals for buying from Seritage, these properties, right? It doesn't matter who Seritage is borrowing from and stuff and who deals of their size would be because they're doing so many deals like we talked about. So who's financing deals of a couple million, like let's say they sold for, what numbers did you have there? How many deals they did? And we can see that so we can get some idea of what I mean.
Yeah. So they sold 27 assets in Q1 for $291 million and has 15 assets without due diligence contingencies under contract for $295.6 million.
Okay. So those are basically $10 million assets.
Yeah.
Right. I don't know, but it's probably not the tiny bank locally, and it's probably not JP Morgan. It's probably exactly the kinds of banks and stuff that we're talking about failing, the regional banks, the problems with that and whatever in each area that are doing that. The relationship may be a lot bigger than 10 million that the bank has with someone, but the assets are that's probably what we're talking about. Yeah. So, the banks that we're talking about being in trouble and that people are worried about them pulling back on lending and stuff, this is what we're concerned about them pulling back on, I would think, is commercial real estate stuff. Like these. And then the thing has to do with the cap rates. Some of the cap rates were really high before, really low. The multiples were high. And then lately they had some, probably around the time you see that stock drop and stuff, that was concerning in terms of how high the cap rates were. So if you apply that to like later ones, then you have a bit of a problem. But I don't know if they are trying to sell the stuff that's harder to sell now or smaller, and then they end up more with their best properties later. It seems like more of that than I expected. It's not the order that I necessarily expected at first.
I think their plan is to keep some of their top tier properties. So just get out of the ones that they don't like, or they like the least.
Right. But that's an interesting issue because if they do that, then that means those are larger assets that are harder to sell in individual sales. If they're good and they think they're going to sell them for a lot, that's fine. But it means that it depends more on individual sales of higher priced things at the end of the process, which might be the most sensitive to interest rates, right? So I don't know. It could be just that what we're seeing, it just has to do with what can sell and when and how fast. And so bigger deals are more of a problem.
It's just interesting. Like you were talking about your the net that you lost money on. And the reason I brought it up was, right, we've talked about merger arbitrage, and you had said that, hey, like there's a difference between the Activision merger arb versus the Spirit one, where if Activision doesn't go through, you wouldn't be as happy to hold it, versus, if Spirit doesn't go through, then that's a situation you like because you'd be happy to hold it. And just this idea of like, from a liquidation perspective, like the certainty versus what you can make more money on, okay, well, if a company is liquidating a stock portfolio, I would say that's probably much more of a certain outcome versus a company like MLP, for example, where if they decided they were going to liquidate the company, I mean, I'm sure you would make multiples more than what you would in a liquidation that is liquidating inventory or a stock portfolio, right? And then just like which one is better. I don't know if one's better. I think it's such a individual thing as it relates to, the certainty versus how much more you can make in one situation versus the other.
Yeah, I think Seritage and Activision are much more tied to financial conditions in terms of the risk reward, because the downside danger comes a lot from either a huge decline in the stock market, which would be bad for Activision, or a huge decline in the economy, in real estate and banking and stuff, which would be the problem for Seritage. Absent something like that happening, I wouldn't be too worried about either one of them. If you could promise me that there'd be as much froth in the market in the future as there is now, then I might be fine with Activision deal. There's enough possibility of something good happening there, and the stock would likely have a high multiple if it all fell apart. But if things decline like they did in 2000 or 2008 or something in the stock market while Activision is trying to close this deal, then when it fails to close it, then it's going to be ugly because this is a high multiple stock. Spirit and Albertsons, doesn't matter. I mean, I don't know that it matters for closing the deal. I doubt it matters that much, and they're much more insulated, Albertsons and Spirit, versus economic cycles and stock market cycles. It's very specific. But there's very strong reasons for why the deals wouldn't happen. Very good reasons why the deals wouldn't happen in those cases. They're much more questionable in some of the other cases. I mean, the Activision thing is, there's not much of a case for why the deal shouldn't be allowed. But so the odds that it would close might be a lot lower, but who cares if the magnitude of loss is almost nothing on the other side. And that's the risk here, is just that the main thing I would say is that the possibility that there's a large loss in Seritage is high. I should say the size of the possible loss is high, not the probability that it will happen. Why? So what ones would I buy and stuff, right? Hunter Douglas, Cambria, right? Some of them, Cambria, for instance, it ended up being like 4% higher price that it was taken out at or something. It was like nothing. But I don't see the harm in that. It could have been even higher. There's nothing wrong with owning the stock otherwise. I mean, the stock would probably be higher than what it was then if you look at what happened with used car prices and things since that deal happened. The thing that I would just be cautious about is remember what you own here. This is very much an event thing. If it liquidates, and you have to evaluate it as an event, because I think people don't want to own this asset. I don't know that this asset is as. I don't think I would like this asset as much as Alico or Maryland and Pineapple. To be stuck with this, I don't think you want to be stuck with the Seritage properties. So you're doing it because it's an event, which is fine. But historically, I'd say that's the trickiest way to do merger arbitrage and event-driven stuff and whatever. The easiest is I don't care that much if this event happens, because if there wasn't an event happening, I'd be happy to own the stock. What you want here is I would like to be in Seritage, even if they said tomorrow we're not going to liquidate, we're going to try to make this work out and start producing operating cash flow and stuff. If that was the case, then I would like it better. But I may be biased because I valued this stock for a long time before the liquidation was planned and, didn't like it. Looked at it and said, no, I don't like it. I don't think that it's as cheap as people think and stuff. So that may be coloring my perception of it.
Do you think you've made more money in your career investing in event type of situation? So you're not an event-driven investor, but I don't know, like if I think about it, I'm going to change the definition of event-driven for you and say, like, I think you made a lot of money in like the extreme type of situation. So like spinoffs, I'm just going to put that in the extreme bucket just for this chat, right? Okay. But like, so extreme certain spinoffs, the Japanese net situations, that was the result of an extreme situation. Other nets, that's probably an extreme situation. We talked about Frost with the Fed funds being at an extreme. spot relative to history. I don't know. Like sometimes I think about you as an investor. I mean, do you think even investing out of '08, right? Like finding those stocks at like FICO at 6, 7, 8 times earnings. I just feel like the most amount of IRR you've had in your career has come from situations that are just very extreme.
Yeah. I mean, if we do spinoffs, nets, arbitrage of some kind, all that stuff together. Yeah. I mean, returns have been better. My returns have been better in those things, annualized, no doubt. I don't know that I've made more money because I don't know that I've been able to invest as much money in that stuff. But yeah, it's more attractive. The risk return is better and stuff. I mean, it's really hard to do what we try to do every day, which is the market isn't undervalued. There's nothing special going on with this situation. Let's buy it. I mean, I wouldn't recommend that like if you could be in an index or you could be in these other deals that we're talking about, I think it'd be better being the other deals. I mean, for most people, I would suggest swap out some of your stocks and put these things in it. If you could handle it psychologically. I think most people can't handle it psychologically. So it's okay.
But maybe that's a sizing thing, Ben. I mean, maybe they don't have to put 20 or 25% of their portfolio in a situation like that. Maybe it could be because of, you could make a ton on the upside because these are ripe for mispricing. Maybe it doesn't have to be a massive position. Maybe it could be a 5 or 6, 7, 10, whatever that number is for you.
Yeah, maybe. I find that that's not true for people. You would think that maybe that would work that way, but the problem is that they don't like being wrong about situations that not working out, right? And it's not being wrong. The idea is, just because the deal doesn't go through or something doesn't mean you were wrong to buy it. And because it does go through doesn't mean you were right to buy it. Same thing when we talked about the preferred and the common and stuff. You could do a postmortem after this and decide, well, was I right or wrong or something? It's very possible that you could have a higher return in something that you would be wrong to buy based on the information that you had at the time, looking back on it and trying to analyze it and understand what the situation was. So that's what you need to do. And and what I mean is like the Cambria one, right? No one finds great joy out of making the 4% or something, but I think that was a very good decision from when we talked about that on the podcast to say, people, you might want to buy this. Now there's like totally illiquid. We couldn't buy it because of laws and stuff in the UK, basically, is that it would make it unimportant to us as a fund because there's no way, given the way that takeovers work in the UK, that we could do it in a way that makes sense. So it just wasn't considered. But making that amount, whatever it was, let's say it was, a few percent, I think actually it was a good bet, and that making that couple percent and not having it go through frustrates most people. But you made the right bet, and you need to get the enjoyment out of doing that and understanding what the odds were of different things. That could have fallen apart and ended up having to be a much higher bid or something. I made a lot of money in something doing that, and no one, And also the Japanese netnets, about a third of them, it was takeovers of the company that I made the money from. And I bet on a situation in which the company was 70% controlled by insiders who were trying to take it private. And I got a higher bid from them. Japanese netnets, people said in Japan, there'll never be management will never buy out the company. It'll never go private, whatever. It did. So, yeah. I don't know. The average person listening to this just is never going to do these deals because they don't like them. It frustrates them. I don't know, but it's just an odds thing. I mean, you could be pretty wrong about a lot of things about these deals in some cases and make money, and you could be right about everything about the future of Nvidia and lose money. It's the pricing of it, the handicapping, like we said about, like Munger talks about, how much weight is Nvidia, as a horse, how much weight is it carrying in this race? Like I said, maybe you could find, some people will argue it's 10%. I think it's closer to 15. It has to do that just to kind of stay in place. When NACO spun off, it was about 7%, 7% the other way, negative 7%. That is intrinsic value could probably decay at about 7% a year, and you'd be at about a break even or something, right? Like it had to actually go down in value probably over time while you owned it for this to happen, because it'd be earning the opposite of what we said with Nvidia. It'd be earning a certain amount of money, and it does something with it. It pays it out, buys back stock, does something. So eventually that pile of cash would be offsetting the decline, right? It's a big deal. So you could be 20% off in terms of you're in the thing that has the high expectations instead of the thing that has the low expectations. But look, NACO hasn't worked and Nvidia has. So, and it could easily go up another 50% or something from where it is. You mentioned there's 22% short interest. I don't know what that's all about. Obviously, people could short this, but they could also be long other things in the rest of their portfolio. I think it's probably a way that people want to play the commercial real estate thing. I don't believe that it could be meaningfully because of people owning the preferred. So, because I thought about that, but I think it's risky. It doesn't make any sense to me to do that.
Do you think
to be short the common and long the preferred?
Do you ever think about these event-driven things like in terms of cycles? For example, like spinoffs, right? Greenblatt, he really raked it in. He wrote the book on it, and spinoffs haven't been as good as they historically were, probably because so many people are focusing on them. You think about SPACs, for example, right? That was definitely a cycle that came through and boomed in 2020, and now SPACs have really calmed down. I mean, do you ever think about, I don't know, like even cycles from like your own strategy of like buying great companies at cheap prices? I mean, we haven't found a FICO at 8, 9, 10 times earnings, or a J&J Snack Foods at less than 12 times earnings. I mean, do you ever think about that? Like maybe I should focus my attention on these other strategies that are, I don't want to say like working, because then you're like having some sort of style drift, but just kind of incorporating these other things that are in cycle right now, if that's the right way to word it.
Yeah, you get different opportunities at different times because the market's always adjusting. People are always adjusting, learning, over-learning some things. Not necessarily that they're learning the correct lessons, but they could be right or wrong, but they're trying to adjust to what happened in the past. So as much as we talk about the Greenblatt book and everything, I don't think spinoffs are necessarily that great an opportunity normally that we've seen. I think merger arbitrage stuff recently is really, the ones that we talked about, is remarkably priced. I even think that the Seritage thing, as much as I've been saying, there's possibilities here or whatever. I mean, the fact that the preferred trades where it does, the fact that the common trades where it does, is pretty attractive versus the market. I mean, it's not what we do, but I would not mind being short the market and long Seritage common, or short the market and long the preferred. I think that's very good. I think it's a smart idea. It could go wrong, but I don't know. I mean, COVID could happen or something again, but like if the market shoots up, okay, then it's probably a pretty good situation for selling the real estate, and this thing could double then, right? Preferred, sure. I mean, you're only going to get the return that you're going to get. So you could have a problem there if the market really goes up, but yeah, as long as, yes, these are more attractive. All the things we talked about are more attractive than the market. Activision, Albertsons, Spirit, this. For a bunch of different reasons. But like standard reasons, like their value things, so they're cheaper. Some of them, not the Seritage Common, but all the other stuff we talked about basically has like more yield. Or some of the other stuff we talked about has more yield than the market, where you're like not getting paid, whereas with the preferred and with Spirit and everything, you're getting these payments and stuff. The one that'll be interesting is, with the Albertsons thing, is if that was to happen, of course they'll have to spin off stores. Whenever there's a big merger between supermarket things, you have to break out some of the stores for regulatory reasons, and that will be adjusted in terms of any merger. But that might mean that there's actually a spinoff that would be interesting at some point, because it'd be like subsize, and it would be kind of interesting. Those are the best for companies that buy entire ones. In the industry, if you can ever get that where companies merge together and they have to sell something off. Telecom, the same way. The best deals I've ever seen in telecom, the best deals I've ever seen in supermarkets, is you buy it to allow them to merge. So, they have to sell to a competing chain somewhere, and that chain gets a really good deal. This one, they said that if it happens, they'll spin it off, so the public would get it.
Is your business quality bar as high in these situations, or is it purely a price thing, would you say? And then maybe perhaps the best situations are when you get the price and you like the business.
The issue here for the continuing value is the durability of it. There's some credit risk stuff, but it's basically the durability of it. So the reason why I would be worried about something like this, as opposed to some other things we talked about, is I'm not so sure about the durability. That's why when we talk about Maryland and Pineapple, Alico, those things where there's no event, I think that, and also when we talked about Q&L Land Association and stuff, the durability of that is much higher. And so what if you get stuck with the asset? That's always the risk. Basically, the downside risk ultimately is the deal doesn't happen, you get stuck with the asset. Are you okay with that? If you're okay with that, this is a good deal. And big spreads are not a problem. Small spreads are not a problem. It's not a lot to worry about that way because you don't have this bad downside. But if you make the mistake, like say in the 2000s or something, there were all these tech mergers and things, right? What if you thought a deal was going to close and it didn't, and it was a .com? Okay, what would happen to you then? You could lose everything. You can lose everything in Seritage if you in the common stock if, like I said, a 2008 event happens, right? Retailers are risky that way because you might depend on other people providing money and stuff for it to be able to keep it going. Yeah, so it's just a question of the durability. You know, the business quality thing isn't so important as long as I feel like the price is fine. If I feel like they're getting a good deal on it, then I always think that you should buy it. If I would do the deal, then you should buy it. There's all sorts of calculations that we can do in terms of something closing, but the easiest way, the best way for having good long-term returns is just if I was offered the deal on the same terms as they are, would I buy it? And of the ones we mentioned, Spirit's the only one that I would do the deal. So Albertsons, I think, is not a bad deal if you're stuck in that industry. And if I was running Kroger, I would do the deal. But I wouldn't want to participate in the deal otherwise. But Spirit, I would, yeah.
Mm-hmm. We could talk about that here in a second. Lionsgate is going to be spinning off a portion of their business. I don't think any of the S1s or any of that have come out yet because they're still talking about it. But they did release a PR on it. Despite the volatile market environment, Lionsgate Entertainment remains on path to separating our stars and studio business. As negotiations progress, we have increased our focus on the possibility of spinning our studio business, creating a number of financial and strategic benefits. In that regard, we are continuing productive negotiations with prospective strategic and financial partners on both sides of our business. So we talk about, movie studios and stuff in the streaming and movie and entertainment industry often on the podcast. So I just wanted to bring that up as we can follow along and see what's going to happen with this separation.
So Lionsgate is a mini major, sort of, to the extent that they exist anymore. It is, a second place type studio that did release a few large movies, but doesn't have a lot of smaller movies and stuff. Stars, I think people know that was like a,
that was
just like we talked about Showtime being
that was
like
a cool
channel.
channel.
HBO. Yeah.
Oh yeah. Growing up, that was like, if you had Stars, that was like your parents were rich, man. At least where I grew up.
Yes. That's definitely true because Stars is not in basic packages that way. Yeah.
Uh-huh.
And then there was some people involved with Lionsgate and stuff that I wasn't the biggest fans of how they ran it and stuff, but some of that has changed over time. So, and the history with Stars and stuff has a little John Malone stuff to it. Do you want to look at? It'll probably be hard to look at the results, but we could certainly do that. If you go to the numbers.com, I can show you some of the stuff that Lionsgate makes.
Yeah.
It's not award-winning stuff usually.
No, I know that.
You'll see. Yeah.
Didn't Lionsgate do the Saw series?
That sounds like the kind of thing that they would do.
They always do like kind of raunchy, scary stuff, I feel like.
Yeah, they were involved in some other things where I think it's a co-thing. We could, the biggest ones I think may surprise you, but let's see. So if you go to the studio, let's see, can you go box office, like theatrical market or studio or something like that?
Okay, so box office, this right here?
Yeah, one of those should have something that you can find a list of the studios,
okay,
like market share or something. Okay, yeah, so just you could click on any year, like
2019,
You know,
pre-COVID.
2019, sure. Yeah, pre-COVID. Let's see if they give. Do they break us down by studio? If you scroll down, they should break down by like genre, biggest movies of the year. I think somewhere we'll give studio. No.
Let's see.
Market share for creative type. Market share for okay.
There you go.
Okay.
Each distributor. Yep.
So do we have Lionsgate listed on the distribution there?
We do.
Okay, so we can click Lionsgate then. All right. So this is what they released in 2019 and what the ratings were. As you said, they have far more R movies you can see there than is normal for a major studio.
John Wick.
Major studios usually put up more PG-13.
Great series.
Yeah, so their biggest movie, so it's broken down by biggest movie of the year, right? So their biggest was John Wick. What do they have there for the top few?
John Wick, Knives Out, Tyler Perry's something, Angel Has Fallen, Scary Stories to Tell, Midway, 5 Feet Apart, Rambo, Cold Pursuit, Long Shot. Yeah, I mean Hellboy.
Yeah. So Cold Pursuit is like a Liam Neeson movie, right? And the other ones people probably recognize. I mean, I recognize at least the person involved with it. They recognize who Tyler Perry is and stuff. They don't recognize the other stuff. So yeah. So a lot of this stuff is probably watched more on home entertainment. You know, like if you click Cold Pursuit, I bet a lot of people saw that on video. I don't think a lot of people showed up in the theaters to watch that one. Because that was he had probably done 10 like this by then. 10 of these Taken clones in the years in between, right? Because they've been about 10 years since that movie. Does it say how much it made in theaters?
So
Domestic?
let's see. Domestic box office, 32 million. DVD sales, 2.5 million. Domestic Blu-ray sales, 3 million. So domestic video sales, 5.5.
It probably streams. Yeah, a lot of the stuff probably streams and they want it to be on streaming things and stuff. Yeah. So it's that kind of studio. And the budgets are usually a little bit lower, right, than the things we were talking about where they're not blockbuster type things. The genre. Yeah.
Do you have any thoughts on the franchise in general?
Not really.
Nothing too positive.
Nothing too positive or nothing too negative. I mean, it's been a public company for a while. I've watched it. I don't know. I don't think the stuff it's done has made great business sense exactly, but it could. I mean, this could change things, I guess, that we're talking about when it splits up and stuff, if it's going to have a difference in strategy. I don't know. I also think financially, I mean, we could look at that situation, what they have in terms of their balance sheet and all that, but it's better if it's combined with something else in terms of just safety and stuff. I don't know that this is the best thing to do is operate the way that they are. I'd be a little worried about long-term how safe it is. It's not DreamWorks Animation, let's put it that way. It's much spottier about whether these are going to be hit or miss. There's not as much logic to why this is independent and stuff. You know, like a DreamWorks made a lot of sense. Disney, when it was an animation studio, made a lot of sense to be on its own. Doesn't make much sense to have live action stuff all on your own in a small format like this. Let's see. They've got plenty of liabilities. But that's probably associated a lot with the stars because they're paying for rights and stuff, you know. Like if we looked at Netflix, it would look like it had a lot of liabilities because they promised to pay for a lot of stuff. But
this is a situation where, I mean, both businesses are going to look dramatically different afterwards. I mean, so aren't those the type of spinoffs that you'd want to see? Because that's where there's the most potential for a mispricing, and you don't exactly know what, it's going to look like, and the pricing could be off, and it's a situation where it's like, hey, there's no market for it, so you have to value it, and perhaps it comes out lower than what you think it's worth.
It absolutely could be true. The warnings I would say to people are, number one, no one will know how to value this after it's split up and stuff when you're talking about the studio on its own, certainly. So the possibilities it gets bought out or something, right, is like how people see an exit strategy. but it's not going to be the sort of thing that reports earnings and things that are meaningful. The way that Hollywood does report financial results is very different from sort of the underlying reality could be. There's a lot of estimation involved in it. I don't think that it works so well on like a PE basis or something. So, there may be analysts that cover it and talk about it, and I think it'll be talked about as a sale thing, just like we talked about with Paramount. People ask why might someone own that stock? Probably because it's a sum of the parts type thing. Certainly, you could have Gabelli talk about this or something, but I don't think this is a stock that we're going to hear a lot from people who listen to the podcast and that we normally read the stuff that they do and whatever, just because it's outside of what they normally kind of cover. Entertainment things I think are too hard for them to like. It doesn't work on the normal metrics of price to book, price to earnings, things like that. So it doesn't even work on EV to EBITDA. Like doing that is kind of crazy. So I think it'll be talked about as like a possible sale thing or something. Once it cleared certain things, it would have an issue for the tax-free thing probably. Where's the company incorporated? It's a Canadian company, actually.
Scroll up.
The auditor's Los Angeles. Is it incorporated in the United States, though?
Vancouver, British Columbia.
Yeah. Yep. But trades on the New York Stock Exchange. Yeah.
Mm-hmm.
But it files a 10K. So it's just a Canadian company that, lists in the U.S. It must not have any listing in Canada, or probably doesn't have a listing in Canada just here.
Got it. Well, we can follow that on the pod. I just want to talk more about special situations, stuff like that's going on. Not just spinoffs either, just other ones as well. Other corporate events. I think it's just interesting to talk about. I mean, we don't want to talk a lot about stocks that we own and that we're looking at on the podcast, but I think it'd be good to just talk about more of these things that are going on in the market and things that we may be interested in as well,
Yeah, I know there's another Canadian company that people like that had an activist in it, actually. But what is it, Thunderbird Entertainment?
Yeah. Mm-hmm.
Yeah. And they do content for streaming things, basically. I think they had one TV show that was pretty big, also Canadian. In fact, they rely entirely on like credits and stuff, government credits and stuff from Canada. But was it Kim's Convenience? It's something. They had one show that was pretty big. I could probably wrong about that. It can't be that. But other than that, it's just stuff that like fills up programming. It's not like Ice Road Truckers or something, but it's close to that. And it's that kind of stuff that you would see all over scrolling through, whether it's Netflix or some other streaming thing all the time that way. And they do a lot of that. But they also, I haven't mentioned Rumor Animation. This company also does production for some stuff on a like cost plus type basis. Like they get reimbursed for it fully, so they're just not taking a risk that way, and unlike what we're talking about with Lionsgate and everything. So it's not my favorite thing. Neither Lionsgate nor this company is my favorite in terms of their strategies, the people involved, whatever. Not that there's anything terrible about Lionsgate. Lionsgate looks like what's inside a lot of other big movie studios, but it's kind of subscale on its own thing. So Thunderbird does, I think, a lot of kids things and stuff, but especially like making things specifically for Netflix and everything. Netflix has more and more of that, and in part probably because some other ones stopped doing it for them, right? Netflix had Marvel doing that for them. It had DreamWorks doing it, so some of the big ones probably stopped. So they need companies like that to do it for them. But like they make a whole series for you, and you just pay per episode or something. So you just promise them that will pay you $1 million an episode or whatever, and you deliver it. And so that's different than than making it on spec and then selling it, right? So it's more like a TV production company. A lot of what they seem to do, I would say. Whereas Lionsgate is pretty much a movie studio once they split this off. Although it's specifically in the category that I think we haven't talked that much about movies recently, but we've had some interesting things happen there. Some of the stocks have done pretty well, and the box office itself looks pretty good. But actually, most estimates that I would have and that sites like The Numbers and stuff would have is actually it's been kind of weaker than we would expect, because what's happened is the supply has improved a lot. The product being put out, it's improved. But there's no evidence of like improved demand, which we talked about before. So like this week, you'll have $100 million. You'll have almost $100 million movie. I don't know about exactly, but like we've had $100 million or more total box office every week for a couple months now, and we will for a while. But it's just because of what's coming out, right? You're going to get to a dead point later in this summer. So like the next 6 weeks or something, it's going to be something major every week. But after that, you're going to get to a dead point for months, and then people are going to say the box office is dead and stuff. Because when you only have if you look at like, you could look at the top movies. Yeah, what do you have there? Okay. So if you look, this site used to be great. Box Office Mojo was once a great site.
I still like it
then
for some
Amazon
data.
bought it. Do you?
Yeah.
The numbers basically copies what that was. I believe Amazon bought IMDb and then did that with Box Office Mojo or something. So, anyway, the issue is like the smaller movies have done badly, right? So like the numbers.com uses a model. And so this is where sometimes in the articles, and I'd recommend this site for people to read just because you really just have to read one article a week. They do a couple, but if you just read like the projections, so what they think it's going to do versus what they predicted each week, you'll have the best overview of the box office you can for a really, really easy read. But anyway, so it uses a model, and that model now says the theatrical market is at 60% of pre-COVID. 60%. It's significantly downgraded. And the reason why is the model doesn't say Super Mario Brothers is a big movie, so let's give it a dollar weighting, as if it's 90% of the box office, let's weight that as 90% of strength. It looks at every movie and says, okay, every movie is doing the median movie is 60% of what it used to be. And that's probably pretty much true because like, the Book Club 2 or whatever, which is a movie for 70-year-old women, a movie with 70-year-old women in it, did not do well, movies like that. We talked about whether it has a romantic content in it or whether it's the wrong age or whatever. But it's a supply issue because Super Mario wouldn't have done bigger. Maverick wouldn't have done bigger. Spider-Man No Way Home would not have done bigger if it had been outside of this time period. So the biggest movies are doing the same numbers. Actually, The Little Mermaid probably is the same, right? So like Little Mermaid's not going to do as big, the remake, as Lion King, but it was never as big a movie in the United States. Now the problem they have is the rest of the world, but I don't think it was ever a huge hit movie in the rest of the world. It's more well-known in the United States. So the thing is with Lionsgate, right? If we looked, all the movies they're making are exactly the movies that no one is going to see in theaters. They're the ones that have dropped off by more than 50%. You can't put out a Liam Neeson movie or, Tyler Perry as Medea, I think some people would go to that. Any other thing, I don't think you're getting. I don't think Lionsgate did. Do you know who did Power Rangers? Can you type that in the numbers? That's the kind of thing that if they were going to take a risk, a studio like Lionsgate would do a movie like that. Like it's a property, but it's that size property and it's kind of risky to do it. So who made Power Rangers?
Let's see.
Who distributed? Anyway, that's kind of as big as they would. They did some other ones too, but this is the category of movie that is kind of the top side of what we're seeing. The bottom side is the Liam Neeson type of stuff we talked about. Certain horror movies, which are doing fine, but these are middle. The danger for a studio like Lionsgate is sometimes some of these the budgets get a little too much for what it is. Let me put it this way. I doubt Lionsgate was ever considered a possible for Super Mario. But someone probably thought, we could do a Sonic with a Lionsgate. Like if we really reach, that's what we can do. Because it is a property, it's known, but right, like if you say Sonic, I think people know it's a blue hedgehog and they know a name Sonic, but they really don't know anything about it, most people. Super Mario is like a whole thing that's the biggest thing in video games, right? So anyway, they're middle tier. All their movies are very middle. They're not the smallest. They're not like these art house type ones and stuff, and the specialty distribution that they have for the big studios of the really small stuff. But they're not competing for awards and things. But they're also not any of the big budget things. So unfortunately, they're right in the area of what people may not go to the movies for anymore, which may be fine if their ideas were a streaming company, right? Like if we sell to streamers, because Sony's doing that. They basically are saying, okay, we're not going to have a streamer. We're going to be the ones who supplies the arms to everyone else in this arms race, the independent ones. So, you could do that with people buying from Lionsgate because they need it for their stuff that you put on Peacock and Netflix and Paramount Plus and Max and whatever. But it's just, they're in the toughest part for the theatrical market, it's the toughest part.
Mm-hmm.
Because their things cost enough that sometimes it's risky, and yet they're not guaranteed. I mean, we've read off the names of them, right? Like, okay, John Wick was okay after the first one, right? Then it became a known quantity that way. But actually doing the original the John Wick script was a spec and stuff. It got Keanu Reeves, who's a known quantity, but that easily could just be a movie that didn't hit, and then it's not a franchise. It's not, they're not some IP that they control a lot of and everything, and it's still in the category of things that can be risky. Because, honestly, John Wick is not that different than Atomic Blonde or something, which is a movie that's the same kind of thing, but not a big success, and John Wick became a big success. So, after the fact, it looks like which is the big one and which isn't, but it can be hard to know ahead of time.
Mm-hmm. Look at right here, About My Father, Lionsgate. They're projected to do 4.2 million in box office. It's just different. It's a different market, different segment of the market.
And I'd have to check, but that probably is not considered a flop for that movie.
Mm-hmm.
Like, they may have hoped that it could do even more, but realistically, people probably thought that would be a $4 million. Yeah. So... that's the stuff that could easily go more to streaming than the other ones. So it's the one that's most in danger for the theatrical stuff, but that doesn't mean that it won't do well for the streaming. And I think if they're going to pitch themselves in a way that like the stock market likes and everything, do you have a chart to see like how the stock's been doing for a while before this? I think the pitch, like I said, the Thunderbird really pushes that idea. Like there's a streaming war out there, and we're supplying it and stuff. Like to investors. That's kind of their pitch to investors and everything.
Yeah, the stock's not done well since 2016. Yeah. I mean, it was around $30. Now we're at just above 10.
Mm-hmm. But the value in the market, like for acquiring, other studios acquiring it and everything, might also be down 2/3 from that far pre-COVID. It also had some bigger movies at one time that we didn't get into, but I don't think matter because I don't think they'll do more of them. But it distributed some stuff that was bigger properties too. But all of them occasionally get one hit that way, Yeah, we can certainly look at it and see what happens. But like I said, like with just those movies, looking at them, you can tell that it's a hard part to evaluate that way, what exactly you're getting. This is a very sort of typical what a movie studio, what a distributor is. And then like if you get a Liam Neeson movie or something that works, then you might suddenly see them do 5 of them in a row because now they have a relationship, right? Now like they know that we can get a movie greenlit there fast and everything. And so you'll see, or Tyler Perry or whatever, you'll see the same producer, the same director, the same actor or whatever repeat because they're saying, yes, let's do this. That's easiest to do in like horror and stuff. But they're really having to pick from things that everybody's seeing, right? Like deals that everybody, it's kind of like what I talked about with Amazon and stuff. Everyone gets shown this and then someone says yes to it when you see it appear on one of these things. And Lionsgate is just one that sees it all. Like I said, like the John Wick one was a spec script. So that can just, any studio can bid on that they want to and buy it instead of doing it that way. I mean, it's just someone wrote the script and then took it around town to sell it. So, so you're basically just bidding against other people to try to make a movie. It's very different than Disney or something, right? Or Warner's, or So what do you have there with? What are you looking at with their?
So they have the Hunger Games now. I don't see the most recent one. So is that like, did that run out, or did they lose those rights, or?
So they did some teen ones that way. They also distributed for what else? Do you have the biggest all time or something?
Yeah, the Hunger Games, Catching Fire.
Okay. Yeah, so they have the whole series there, right? That's their top however many?
Correct. Yep. So the most successful one that they've ever distributed, the Hunger Games, Catching Fire, it grossed in nominal terms $424 million.
Mm-hmm. Big.
Yeah.
Yeah, but let's skip that. In other words, let's skip over Hunger Games and see what's the top things after that. No, well, just like they're not going to make Hunger Games every year. Twilight, I can tell you, Paramount did Top Gun, so or whatever. So, sometimes ones have, so Knives Out, right? And Knives Out, the second one basically went to streaming. They released it for 2 weeks in theaters, but it basically went to streaming. So that's what I mean about, and Knives Out is a really successful version of the kind of movie they would want to make. Like, this is the good outcome for them, is what you saw with Knives Out. That's exactly the budget, the type of movie, everything about that is like exactly what they would want to do, I think. Horror, too. When you hit, the first, you could look at a horror franchise. Most horror franchises have the highest possible return on investment for the first movie. Then they start dropping off after that, But if you want to know how to make as much money as possible in movies, like have the highest payback, it's horror, because you can make a movie for $5 million that makes $50 million, and people, and like the general public doesn't even know it happened. But people who love horror alone could make it go to 50 million. It's not even has to be a huge hit, but you can't make 10 times what you put. Super Mario Brothers kind of did. We went over that, but normally you can't. There's no way to make 10 times your money on Avatar, right? You'd have to make $3 billion or something.
Yeah.
But there can be some horror franchise you don't know about, and you're like, wait, they made 7 of these, and they each, doubled or tripled their money or whatever. But they tend to drop off. Right? Because like Lionsgate, I think, follows a pattern, kind of like maybe Dimension did, certainly New Line, where they put out it like annually. Like if you go to the numbers, right, you could see the Saw franchise. You could probably, it can, if you go down, I think it lets you pick franchise or something. Like, are you into the Saw movie as a movie?
I'm on
where it says like the production. Okay. So box office for Lionsgate. But anyway, if you can see that, like, so what do they have under, like, so Knives Out. So first, let's just do like, what was the gross? So what do they have in the gross for individual movies that weren't the Hunger Games? What levels are we talking about here?
Yeah, and you want to take out John Wick as well?
Well, is it the first John? Well, no, they've done what, 4 of them or something? Yeah, so that's the next one, right after Hunger Games is John Wick. I'm not saying that these don't count. I'm just saying, what else do they put out so people know?
So Knives Out, $165 million, La La Land, $151 million, Fahrenheit 9/11, $119 million, Divergent, $150 million, Wonder, $132 million. The Expendables, people probably recognize that, $103 million.
Right, The Expendables. So the issue there, so this studio's been around a while. The issue there is like Knives Out is the biggest version of that. Like that's the most you could ever do. That's a breakout of that kind of movie. That kind of movie would never make that much money. La La Land, same thing, right? I just said it doesn't win things and stuff. I guess La La Land was nominated for stuff. The same with each of those that we just did. Normally they're much smaller, obviously, but that's what they're hoping for. Is like we said, like one that hits big on that. But in terms of what their actual schedule, do they have their release schedule or something? Like those are their biggest hits, but their actual normally filling it up with, I'd say, more genre stuff. A lot of it's horror, teen, Black. What else do they do? Things that might be underrepresented by major studios, usually. Things that could do maybe a little bit cheaper.
Well, here's the difference, right? We just talked about Little Mermaid that is right around 100 million. Well, this past weekend, they released a movie called About My Father, and it did 5.3 million. Yeah, it's just different.
Yeah.
And you're right, though. You look at in June through the end of the year, it's horror, thriller, horror. There's some comedy, drama, but yeah, it's a lot of horror. Action.
Yeah, the tough thing about that is it's just like someone's taste of whatever they're approving and stuff. So you have to kind of watch it that way. It's culture and all of that. But like I said, it's basically you're seeing everything that all of them are seeing, and you're saying we'll make this. So it's like book publishing or something like that. Like, you know, we have certain editors or whatever, and this is who they work with and what they do. That's what you're seeing here. So it's very typical of this is what studios used to look like a lot more, but they're not what they've looked like certainly since Marvel, but I'd say maybe even longer than that. The last 20 years, certainly the last 15 years or so. It's been a lot of franchises and all that stuff, and people aren't used to seeing studios that look like this. This is a lot of the business that Buffett and Munger complain about and stuff, is this kind of studio, this kind of era. So we'll see what it looks like and everything. It certainly could be attractive for someone to buy. I mean, certainly Amazon should buy it, but, you know, we've talked about that before. There'd be other ones that might be even better to buy, but if something's independent like this, you could buy it. And if you're Amazon, if you're Apple, if you're any of those, you probably want to buy something like this. Just if it was split off so it's completely its own studio, instead of trying to do this yourself. That, you know, they would have saved themselves trouble in the past, I think, if they did that. Bought an entire studio. Amazon did buy MGM, but it's sort of a defunct studio. So,
Well, we will follow it on the podcast, so stay tuned. But I want to thank everybody so much for tuning in with the both of us on the Focus Compounding podcast. Be sure to check out all of our content on the internet. Follow me on Twitter to get access to everything that we push out into the world. And if you're interested in learning about our money management services, reach out to me directly at andrew@focuscompounding.com. Be sure to hit that subscribe button wherever you are listening or watching us, and we will see you next week. Take care.